Okay, so as we've been going through the trade strategy and execution, now we're going to get to finally make the trade. Okay, we've actually had an appropriate trading strategy been identified. Now we've got to implement this trade. So I want you to think about now we're into implementation. Now, as we go over this section, I have to warn you, there are pages and pages and pages of Kaplan notes of more information and more information and more information about these different trading strategies. What I'd like you to remember is as you go through these, I want you to think about, well, that's great to know all these definitions, but which ones am I likely to be tested on? So we're going to help you with that. And what I want you to focus on in this material is really which algorithm. So I'm going to give you all sorts of algorithms. We're going to go over all sorts of strategies. But the question has become, given a certain trading scenario, which one is going to be appropriate? Okay, so that's what I want you to think about and really focus on what is the appropriate strategy for execution. Okay, so again, this is where the magic happens. You either do a great job executing the trade or you don't. Okay, so trade implementation choices are going to be listed as follows. We can have a high touch approach. What does this mean? That means you're going to have high levels of human involvement. They're usually required for block trades or what we call large trades, and they generally happen in less liquid markets. So as we go forward, start thinking about, a high touch trade in a less liquid market, I wonder if that would be appropriate for fixed income. You know, those are things I want you to think about. What would be more appropriate for a futures trade? What would be more appropriate for a bond trade? What would be more appropriate for a stock trade? That's really the granular level I want you to get down to. Okay? And the problem with these high touch approaches, finding the other side to take your trade is much more difficult. Okay? Some examples of high touch approaches. Well, how about a principal trade? Or we also call these broker risk trades. So the dealer or market maker is going to assume all the risk relating to executing this order, and they're going to price it into the spread. We also have quote-driven, over-the-counter, or off-exchange markets, and these are primarily principal trade markets. Okay, also principal trades include request for quote or request for price markets, where market makers, they don't provide continuous quotes. So for instance, if I'm trying to figure out how much to sell this fixed income security for, hasn't traded in months, I need to call up and get an idea of what is the request for quote. Okay, so these are all types of principal trades, and this is all a type of high-touch approach. So you hear about algorithmic trading and all these artificial intelligence. This is good old-fashioned people. Okay, so that's what we're dealing with here. It's high-touch, high hands-on. Okay, now we have agency trades. So again, the broker's finding the other side of the trade, but one thing we got to be clear about, the risk stays with the PM or trader. Now, on these types of agency trades, where do we mostly see those? This is in electronic trading. It's used in more liquid markets, and they're typically order-driven. So these electronic systems, they allow buyers and sellers to advertise their limit orders through a central limit order book, and oftentimes the exchanges or the central limit order book owners will sell you access to see these. So these can actually help when you're trying to figure out your order. Now remember, a limit order is an order to trade at a certain price or better. Don't confuse that with a market order. A market order says, go ahead and execute right away. So you know you'll get filled, you just have price uncertainty. The limit order is backwards. You get price certainty, but you don't know if you're going to get filled. Okay, so the CFA Institute seems to really like to focus on limit orders versus market orders. So Dan, don't lose easy points here. Okay, so electronic trading, let's talk a little bit about this. This seems to be what everyone thinks about with trading now. So it involves direct market access, or DMA, and this is where we see the algos, or the algorithmic trading. So what do DMAs do? They allow buy-side PMs or traders to access the exchange's order book. So directly through that broker's technology. So I can see what's out there. And algo trading is going to use program rules to electronically trade. And I want you to think about this for a second before you start digging into all sorts of algorithmic trading routines and really going off base. What is it used for? Profit seeking and trade execution. Those are the two primary uses of algorithmic trading. And again, we're going to go through a lot of different types of algorithmic trade strategies. But just remember, ultimately they're looking for profit, or they're trying to figure out some way to best execute this trade. So profit-seeking algorithms, they're going to use real-time market data. So think about if you can get better access to the markets. This is why people are building tunnels and always worried about getting to the market faster and faster and faster. Because profit-seeking algorithms can determine which securities to buy or sell, and ultimately they're employed by these quantitative funds and high-frequency traders that we hear all the stories about. People write the books. It seems to get most of the attention from my graduate students in finance. Now, execution algorithms, they're actually looking at rules specified to meeting the manager's goals. So they're not looking necessarily for profit, they're looking to execute the trade. So what are some execution algorithms? Well, we have scheduled algorithms. One term that I want you to get familiar with are POVs, or percent of volume. Also, VWAP is back. TWAP, we built those into algorithms. So they're going to execute trades using rules driven by historical volumes. And they're going to break it down to specified time periods. So these POVs, or percent of volume algorithms, also called participation algorithms, they send orders according to a volume participation schedule. So they know, okay, this market seems to trade 5% every hour. So I need to trade 10% of the average daily volume. So let's do this over 2 hours. So they're going to look for the scheduled algorithm is looking for those specified time periods where basically we can go ahead and participate in this trade. Okay, we also have with POV algorithms, just like any strategy, I want you to take a step back and think about what are some advantages and what are disadvantages. This is how you're likely to be tested on the exam. So a POV algorithm, what is an advantage? It automatically exploits increased liquidity. What's a disadvantage? It's going to continue to trade at a potentially bad price for you. And it also may not fill an order in a specified time if there's low liquidity. So again, it's going to hunt for increased liquidity, but it doesn't mean you're going to like the price that it trades at. So on all these strategies that we go over today, I want you to focus on what is an advantage or weakness or strength or weakness for each of these. So POV algorithms, absolutely, I would understand that for the exam. What about VWAP and TWAP algorithms? Well, they're time slicing algorithms. What are they doing? They're carving up the trades and they're slicing and dicing it, and they're sending it based on historical intraday volumes. So let's talk just for a second about intraday volume trades. Well, what do we know? There's a lot of trades in the opening, there's a lot of trades in the close, and less in the middle. So there's not a lot of trade, and maybe traders get a big lunch during the day and it takes them a couple of hours to digest. It's just kind of dead in the middle. So this TWAP algorithm performs a similar task. However, what it's ensuring is that an equal number of shares are traded in each time period. So for example, each hour, each 10 minutes, whatever you're looking for. Okay, so VWAP, let's explain advantages and disadvantages. So advantage, I can ensure that a specified number of shares are executed in the time period that I want. But what is the disadvantage? It may force trades in times of low liquidity or trade too little in times of high liquidity. So again, not exactly what I was hoping for in disadvantage, but at least it's going to ensure that a specified number of my shares are going to get traded. Okay, how about a liquidity seeking algorithm, also called an opportunistic algorithm? They're going to look for favorable liquidity conditions that are offered by the market. So if I'm basically a buyer, and let's say this algorithm is going to wait until a large seller appears and then enter my market order, it's going to help me get a better price. And it's also going to hunt out for that liquidity. And it's going to use both lit and dark markets or venues that we talked about last time. So dark pools are dark venues. Lit is just going to be an exchange. Okay, we can also have an arrival price algorithm. So it's going to try to trade close to the market prices that are prevailing when that market order is entered. So algorithms are going to trade more aggressively, basically than other algorithms to trade more at that arrival price. Dark strategies or liquidity aggregators, they're going to execute trades in dark pools, and they're going to try to optimize this across multiple dark venues. So again, we keep going deeper and deeper and deeper and more information and more information. These slides that we have here at Kaplan, I believe are perfect. They give you just enough depth and understanding. You don't need to dig out any more algorithmic trading textbooks or diving into piles and piles of material. Just be familiar with what we have in our notes and for the slides, and I think you'll be fine on this section. And then we have what are called SORs, or smart order routers. So they're going to be algorithms that determine the best destination, either lit or dark, to route that electronic order to get the best results here. So think about what we're actually getting into now. Now we're getting into artificial intelligence, machine learning, all sorts of things that 10 years ago weren't even possible. Okay, so SORs focus on getting that best price for the market order or the highest probability of execution if I'm dealing with limit orders. So this is where, we covered a lot of terms. This is where I really want you to feel comfortable, and this is where I'm going to ask you to do a little bit more work. You know how this exam goes. They're not just asking you definitions. They want you to understand, and they assume you know what the differences are, but then they expect you to do something with that material. So which algorithm? This is a key section that I would like to emphasize as you prepare for the exam. So let's talk about what about a scheduled algorithm? So they're appropriate for relatively small orders in liquid markets for portfolio managers with less urgency. And they're concerned with minimizing the market impact. So don't trade immediately. Let's do this without impacting the market. So those are scheduled algorithms. Well, we can also use a liquidity seeking algorithm. So they're going to be appropriate for orders in less liquid markets, but now instead of a lower urgency, they have a higher urgency. And again, same thing, they want to mitigate this market impact. Okay, so we've covered scheduled algorithms, we've covered liquidity seeking algorithms. Let's keep going. So these liquidity seeking algorithms, so they're going to be appropriate when the portfolio manager is concerned that maybe displaying this limit order is going to lead to information leakage, or when liquidity is very thin and maybe there's even some sporadic episodes of high liquidity. Now we can use an arrival price algorithm. So what are they appropriate for? Small orders in liquid markets, and they're used by portfolio managers who believe prices are likely to move against them during this trade period, and therefore they wish to trade more aggressively. So these are profit-seeking managers. They're very concerned about the price, and they're worried the market is going to move against them. Okay, arrival price algorithms can also be appropriate for risk-averse managers who simply want to minimize the risk of not getting executed, or execution risk, or not getting this order filled. We also have dark strategy liquidity aggregators. So they're going to be appropriate for large orders in illiquid markets, and they're going to have arrival price or scheduled algorithms, and they're worried that they're going to lead to high market impact. Okay, there's a lower chance of execution exists in dark pools. So again, we have to be comfortable that, guess what? If we go through this strategy, you don't need to execute this strategy immediately, the full order, because it might not happen. Again, that's why it's so important. If you pick the wrong strategy and you need this order to be completely filled, this is not the appropriate strategy. And then we've talked about SORs. So they're appropriate when for small market orders with low market impact, where the market can move quickly, or even for small lit orders with low information leakage, where multiple potential execution venues exist. Okay, so these are starting to get a little bit hairy, and I know it's a lot to keep up with, but just focus on these key algorithms, and I think you've got a great chance of picking up some points on the exam. So let's look at a question. This to me shows, do you know this material or do you not? So we've got a portfolio manager. They want to execute 3 trades. Which algorithm are you going to choose? Which one is the appropriate? So I want to give you a quick lesson on how I would look at this. Okay, we've got a stock. We got the ticker symbol. We've got a buy and a sell. We've got a side. Okay, nice. We've got a share price. Okay, great. Here's where I want you to focus on. Right here. Order size. So we need 10,000 shares. The average daily volume is 20,000 and the urgency is high. So you're basically want to trade half of the average daily volume and you want to do it immediately. You're very concerned. So that tells me something. Let's look at TWEL. Order size is 5,000 out of 100,000 average daily volume, and the urgency is very low. Okay, I know how to do that one too. And let's look at UDSL. Well, here's interesting. 1 million order size, 1 million average daily volume. So we're trading 100% of the average daily volume, and luckily the urgency is low and not high. So they've given us 3 trades. Tell us which is the appropriate algorithm. Completely fair question, and I think it's very testable and a reasonable question. Okay, so the manager considering executing the orders using the 3 strategies: a scheduled algorithm, a high-touch principal approach, and we have a liquidity-seeking algorithm. So recommend the most appropriate implementation strategy for each order, and look at the note. Each strategy should only be used once. So please don't write scheduled algorithm 3 times as your answer. Yeah, you'll get one of them right, but you'll miss the 2 out of the 3. Okay, so SFDL. We're going to say that they should be purchased using a liquidity-seeking algorithm. Remember when we went back, this is half the average daily volume, and we have an urgent request. So basically, we're going to use this liquidity-seeking algorithm. So we've got low liquidity in the market. We've got a high order size. It makes minimization of market impact the key consideration. And that's what liquidity-seeking algorithms do best, because it's only going to trade when liquidity is offered by that other side. Now, the high urgency of the trade also makes the liquidity-seeking algorithm appropriate because execution should occur relatively quickly. Okay, so again, it's not okay to just understand the definitions. You got to apply it. And these problems help you better understand the material. Okay, what about TWEL? So let's go ahead and just use the scheduled algorithm here. Remember, it was a low urgency of the trade. It was low average daily volume. I think it was 5%. So what are some things that we have to deal with? So with this low order size and relatively high liquidity, any scheduled algorithm, a POV, a VWAP, or TWAP is appropriate. So these are going to trade passively through the day, so they're going to minimize market impact cost. Now remember UDSL. UDSL was where we were trading 100% of the ADV. So I need a high-touch principal approach. So using an algorithm, sorry, is not appropriate. Artificial intelligence isn't there yet. We're going to have to use a person. Yay, so the person can still have a job. Okay, and it also, this algorithm is not going to be appropriate because we're worried about information leakage here and high market impact cost. Now, the difficult part, discretion, is going to be required. That's judgment. Artificial intelligence just simply is not there yet. So we need human intermediary. So in this case, the high-touch principal approach is the best choice. So again, as I defined and we went through which algorithm is appropriate, I think that's a very testable part of this material, and that's how I'd like you to approach being prepared in this trading section. Okay, so diving into, again, which algorithm? Guess what? Technology's gotten better. Artificial intelligence is getting better. We almost have fully driverless cars, but I think we're still, 4 or 5 years or longer away from that. I don't think we're as close as it seems, even though just yesterday I saw someone sitting in their car that looked like they weren't paying any attention at all, and their car was driving for them. So some recent developments in algorithmic trading are clustering and high-frequency market forecasting. So what is clustering? Well, it's a machine learning language where the computer is trying to identify what is the optimal algorithm that we should use based on key features of the trade. Now, this idea of clustering, it's actually grouping together trades with similar attributes. Order size, for instance, as a function of ADV. So again, it's a machine learning language that's trying to figure out what is the best algorithm that we should be using. So clustering is very similar to the approach used in the previous example to select the optimal order. The difference is clustering is going to quantitatively test those factors for the input on their performance in the different algorithms. So this machine learning nature of the process means clustering is trying to identify features of the trade and then determine the optimal algorithm. And a huge advantage of this, of course, it probably can think a little bit faster than a human, and more importantly, it can do calculations faster than a human. And it may even help you figure out algorithms to use that you didn't even consider. Okay, high-frequency market forecasting, what is that? It sounds kind of interesting. Well, this tries modeling short-term market direction. Guess what, though? There are a lot of reasons why the markets move, and it's very hard to try to explain that movement. So what do they use? They use lasso. It's a machine learning technique. It helps reduce the number of explanatory variables, and it's trying to get it to a manageable number of significant variables so it can try to do a better job of modeling short-term market direction. This is the future of trading. It's happening right now. I imagine people are using it as we talk now, but I think it'll be a number of years until they have a lot of the bugs worked out. Okay, characteristics of key markets. This, to me, is another key section. This is where I would like you to focus your extra time after, of course, you use implementation shortfall, which we're going to get to pretty soon. But characteristics of key markets, where are stocks likely traded? Where are bonds likely traded? Futures. This is stuff we need to know as a portfolio manager, and I think this is very reasonable to be asked of you on the exam. So guess what? Stocks are usually traded on stock exchanges, normally lit markets, but they also can trade on dark pools. The equity markets are actually the most technologically advanced, and most of the trading is executed electronically, and this use of algos or algorithm is extremely common. Now, in contrast, let's go to the fixed income market. So what are we doing there? We tend to trade a large number of different types of bonds and heterogeneous securities. Many of these issuers have multiple securities outstanding. So while fixed income markets tend to have low liquidity, the typical order size is large, much larger than stocks. Now, unfortunately, this is not conducive to algorithmic trading. So due to these characteristics, trading in fixed income is mostly through dealer-based, quote-driven markets. And there are electronic requests for quote systems that are becoming, I guess, more common. But again, algorithmic trading is pretty much limited to only the most liquid on-the-run treasuries and futures contracts. So a small percentage of the fixed income market. Now again, over time, that's likely to increase, but today that's where we are. Okay, now electronic trading, it is growing for corporate bonds, but it really is only relevant for a small fraction of that universe. No extent similar like we talked about with equities. Okay, the other thing that's important to know about fixed income, I would immediately start thinking about high-touch execution methods, especially with urgent trades. If you have an urgent trade, you're going to use a high-touch approach, and you're most likely to use a principal broker that's going to take that risk. If it's a less urgent trade, go ahead and use a broker agent approach, but you're still using that high-touch execution method. Again, the fixed income market is not as transparent as the equity market. Algorithmic trading just isn't available for the large majority of these stocks. So electronic trading is, though, common for exchange-traded derivatives. Now, algorithmic trading is not as common for the equity markets, but it is used more for futures than for options. So kind of diving into this, buy-side traders are generally using DMA or direct market access. So over-the-counter derivative trading takes place in dealer-quoted markets. And guess what? Again, they're using that high-touch approach. Now, since the credit crisis of 2007 to 2009, regulators have tried to increase transparency and central clearing of over-the-counter derivatives. For example, interest rate swaps. So again, summarizing, algorithmic trading is not as common as it is for equity markets, but it is used for futures much more so than options. Now, spot foreign exchange trading pretty much takes place in over-the-counter markets. It does use electronic trading. It also uses high-touch broker trust approaches. But for urgent trades, it seems like we still go back to these RFQs that are used with brokers. Okay, for large non-urgent trades, scheduled algorithms or high-touch agency approaches can be used. And again, small trades are usually implemented by DMA. Okay, so again, you can listen to me talk, especially if you can't sleep at night. Certainly feel free to replay this. I promise you'll fall asleep pretty quickly probably, so don't listen to this in the car. But here's where I want to bring your attention. I want you to focus back. I want you to apply what we're learning. So let's try to figure out, what trade approach should I take in this example? So the trading desk of a large multi-asset buy-side firm, they just got 3 orders. They got a futures trade, an agency mortgage-backed security, and a stock trade. The futures trade is small, the urgency is high. The agency mortgage-backed trade, the size is medium, urgency is low. The equity trade, the size is large, the urgency is low. Okay, so now the trading desk has to figure out which trade approach is best. Okay, so the trade desk is considering executing the trades using a DMA, a scheduled algorithm, or a high-touch broker risk approach. So recommend the most appropriate strategy for each order. And again, note each approach should only be used once. So again, please don't write the same answer for all 3 of your answers. There's not a whole lot of material here, especially if you stick to the Kaplan material. Understand the basics and that you can apply. Show that you understand what these means. It's so much better than understanding just the definition. Okay, so for the futures trade, let's start with that one. If it's a futures trade, I want you to think DMA. So futures trades have well-evolved electronic trading, and it's likely that an urgent small trade in futures can be executed effectively just by going to the exchange system directly. There's no need to employ a high-tech approach or a broker because it's a small order and it can be easily executed on the exchange. Okay, so I hope everyone got that. When you think futures trade, I want you to think DMA. And just to be clear, algorithmic trading is not well developed in derivatives. You do see it in futures. It generally is not in options. So a scheduled algorithm is likely going to take too long. And remember, this was a high urgency trade. So the most appropriate strategy or approach for the agency mortgage-backed trade is going to be this high-touch broker approach. So we talked about this already. Unless it's an on-the-run security, there's not going to be a lot of transparency. So fixed income markets outside of treasuries and corporate bonds, they're typically going to use this high-touch brokered execution method. There is unlikely to be algorithmic or DMA available for agency mortgage-backed securities. And then finally, the most appropriate trade for the equity trade is just going to be a scheduled algorithm. Why? It's likely that the trade, being large, would have too much market impact if we used a DMA. It's also unlikely that a high-touch broker trade would be appropriate because the trade is not urgent, and anyway, most of the trading in equity markets is conducted electronically. So again, we covered a lot of information. I feel like we did Trivial Pursuit for trading strategies. There are a lot of terms here. What I would like you to focus on are more the characteristics that we just went over. Where are stocks most likely traded? Where are bonds most likely traded? Where are futures? Who uses algorithmic trading? Who doesn't? And then I'd like you to focus on, if you are doing algorithmic trading, which algorithm is appropriate for that trading strategy. So again, I know this is a lot to go over, but stick to what we put together. I have confidence in our material. I think it's excellent, and I think it gives you just enough insight. And remember, implementation shortfall is where the heavy points are going to come on the trading section. The other things here are just, it's almost Trivial Pursuit, a point here, a couple points there. But remember, you can fail the exam by 1 point. It also means you can pass the level 3 exam by 1 point. So picking up these small points here or there, they all add up. So keep working and we'll get there.